Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
So let's, now what do you think? Is it too bright? Should we go for less light? What do you think? Should we try it? See how it goes. Tell me if you think it was better before. Okay. Better? Thank you. Right. So I'm going to be your convener in this course, Taxation Law. So I hope you find it really worthwhile. So my name's Sonali Walpula. You can call me by my first name. Now, I have one rule in the lecture theatre, which is if someone is speaking, so I guess most of the time that's me, but it could be one of you, when I call for participation, everyone listens, right? So no private conversations, right? Look, so I'm still really glad you're here. So even if I see you having conversations, I'll just wait, I don't want to discourage you from not coming, but just, to get the expectations right, no private conversations if someone else is talking. Right. So the lectures are really important. The tutorials are important. The material that we provide you, right, via lectures, tutorials, sometimes additional materials on Wattle, that's the basis of the examinable material. Right? So I would say it's more important than the textbook. We do have a prescribed text, but when I'm setting the exam, I don't really look at the textbook, even though, of course, it covers relevant concepts. I think about what has been covered in lectures and tutorials. Okay. So it's apart from the fact that I think that it's important for your learning, I think it's vital in terms of adequate exam preparation to come to lectures, tutorials, and I think I said in my note that I posted onto the forum today that there's also important information that's only conveyed in the lecture. Okay. That's exam hints, right? So, and now if you're a person where you usually come to lectures, but for some good reason you can't make it one time, then feel free to ask me, did I give any exam hints out in that lecture? And I'll let you know, okay? Right. Okay, so let's go through just some key points from the class summary, we call it now. We used to call it a course outline. And then we'll get started with our first introductory lecture. Okay. Okay, so the textbook. How many of you have a copy of the book? Good. Any hands up? I would recommend that you get a copy of the book. Look, the important thing is that you have access to the book. So if you want to share, if you can share with someone, that's fine. I'm not saying definitely you have to go out and buy it. You would be able to manage with a copy from 2018 or 2017. However, there definitely have been changes to rates, and so it's a responsibility on your part to update then using lecture materials, okay? But yeah, now, because I just said it's the lectures and tutorials that are the key to the exam, right? But so the reason I say also please have access to the book is because I do think it's helpful for your learning to read material, to read explanations of key concepts, of cases, more than the lecture material. It deepens your understanding, okay? So the Harry Hartog bookshop, it does have copies of the book. On the weekend, it had 55, right? So, and when they're running low, they will order more. And if they haven't put it on the bookshelf, which they had not on the weekend, and it was out the back somewhere, then just ask them for it at the counter. Okay, so you see in the class summary the schedule and the order of topics. So we will stick to that in terms of order. We may not be always at the right point. Often we're a bit behind in terms of what we're supposed to be up to according to this schedule, but usually by the end we've caught up, so it's fine. So assessment, now you're all very interested in assessment, I think. It's actually quite simple to explain the assessment. There are going to be 2 quizzes conducted in tutorials, right, twice, in week 6 and towards the end of the semester, and the quizzes are optional and redeemable, right? So you don't have to do it, okay? And if you do it, it will not count, though, if you get a better percentage in the final exam. So it's redeemable against the final exam. So I would recommend that you do the quiz. You know, it's a good test of your knowledge. And look, if you study for it and you get an okay to good mark, then that does take the pressure off in terms of the exam. So then we've got quite a significant piece of progressive assessment, the take-home exam, which is weighted at 30%. Now, you'll get actually around a week for that, and historically I've often given a few days extension as well. So actually it's quite a long time you have to do that. So, and the reason why you are given a week and often an extension as well, and if there's an extension, it'll be just granted at that time, depending on whether, it looks like people need it, and it will be given to everyone. And the reason why you're really given quite a lot of time to do it, even though it doesn't require research, I don't require you to do research, it's answering a problem based on the knowledge you've learnt in class, is because around that time you've got a lot of other assessment, right? Often mid-semesters. So that's why you've got quite a lot of time to organise it around your other commitments. And then final exam, 60%, right? That exam could be worth 65 or 70%, as the case may be, depending on your quiz status, right? Whether you did the quizzes and then your comparative performance, quiz versus final exam. Okay. Look, I think that's all I want to tell you from the class summary, just the essential points. Now, go to Wattle, where I've got my consultation times, right? So there's one Thursday morning, then there's Thursday afternoon 2 to 3, and as well, if you can't make it on either of those times on Thursday, then we can make an appointment. So, and a good time for appointments for me is usually Friday afternoon sometime, if you have some availability then. And shortly, I will post tutors' consultation times as well, right? Perhaps even tomorrow, if I can get hold of them by then. All right, I think we can start on the material. Do we have any questions before we get to that? Okay, well, that's good. Right. So now this lecture in week 1 is introductory. It's an overview. I think it does cover key concepts that you will definitely need for the rest of the course. They're foundational concepts, right? And however, even though it really covers critical points, by the time you get to the final exam, I don't think you really need to go to the week 1 lecture to revise, because you would have already covered those critical concepts in much more detail in subsequent weeks. Okay? So in today's lecture, you can relax, right? I hope you enjoy it, right? Feel free to ask questions or make comments. So let's start with the meaning of a tax. So I think you already have a sense of what is a tax, just based on your general knowledge. So does anyone want to make a comment? Just based on their general knowledge of what they think is meant by a tax? And you don't have to be too influenced by what I've got there on the slide. Anyone want to have a try? Now, that's okay. That if you look at that definition, and that's from the Oxford English Dictionary, you notice in that definition, you see the word compulsory, right? So that's a key component of a tax. It's mandatory. It's not optional. It's a compulsory contribution to the support of government. So there is no concept of tax in the common law according to judge-made law, right? You've all done commercial law. It's a prerequisite, right? We have 3 sources of law in Australia. So there's a Commonwealth Constitution, ordinary statutes, and the common law, right? The source of tax, right, the legal status comes from statutory law, from statute. Yes, of course there are cases which interpret what the statutory provisions mean, but the validity of tax comes from legislation, right? And we often talk about, you know, the government as having, you know, introduced this tax. Well, I mean, technically, well, there's a complication with this too. We can use government in a wide sense and a narrower sense, but even though we talk about the government, because definitely in Australia it is the government in power that controls the legislative agenda and the tax agenda. So in that sense it's true. Technically it is the parliament that passes the tax laws, right? So it's a mandatory or compulsory contribution to the support of government, right? It funds government expenditure. In fact, we're going to see that the Commonwealth or federal government is utterly dependent on taxation revenue to function. And look, it's good to see the definition, because you see how broad tax can be, right? Levied on, it could be levied on persons, property, income, commodities, transactions, etc. Right? Could be fixed rates, could be all proportional to something, proportional to income, could be. Other words for a tax: duties, levies, tariffs, charges. Now, in terms of that meaning of a tax in law, a critical part of the definition is that a tax is not actually directly a payment for services. That point was made in a constitutional case, and there would be other cases referred to in your book, Matthews and Chicory Board. You don't have to know the case, it is referred to in your book. And even though Australian society benefits from taxation in the sense that government spends taxation revenue to, at least to some extent, on services and infrastructure that benefit everyone, there's no direct relationship between how much tax we pay and how much we benefit. So it's not a payment for services, right? So this is covered in your book quite well, I think. So I really think it is pretty useful for you to read your book. I would say read chapter 1 and chapter 3. I think you can skim chapter 2, which covers study skills. So in terms of the uses of tax revenue, you know, the Commonwealth government and state governments that also raise taxes use that for public purposes, you know, for essential infrastructure, roads, health, education, to provide a defence force, a court system, police force. Now, actually, it's probably convenient to mention this point now. Okay, there's a really interesting pie chart in your book. So it's about the uses of taxation revenue, and this is looking at the Commonwealth government specifically. You know, what is it spending money on by proportion, right? So, and it's a question I like to ask because I think it's something, it's really quite important to know in terms of, you know, government expenditure. We're going to see the statistic in a moment, is nearly all funded by taxation revenue, right? And I think it's something that the person, most people in the community, I would think, are interested in. What does government spend the taxation revenue on? What are the major items of expenditure? So now this is something I do like to ask, and you can just have a guess. Don't worry at all if it's, you know, there's, you know, no such thing as really right or wrong here. It's just you having a, you know, thinking about what might the government be sort of spending the taxation revenue on, and what are the most important items of expenditure. So what do you think? So we've got sort of a list of things there, and then also look at the rest of the slide as well, right? So what do you think sort of might be the biggest item, or if you want to name more than one, you know, in terms of what government spends money on? What do you think? Education? Okay. Defence? Yeah. Infrastructure? Yeah, it would be, but I think that's falling under this big other category in the pie chart and not earmarked. Now, education is 7% of the expenditure. Defence, 6%. Sorry? Medical, good. Health is 16%. But then there's one that is much, much bigger than anything else, and it's 36%. Sorry? Welfare? That's it. Redistribution, welfare is 36%, right? So, and much bigger than anything else. Well, I think I think a lot of people would be quite comfortable with that, I hope, right? Because I think, well, look, certainly some people will not like that. It really depends on how you feel about egalitarianism. And the thing is, a lot people, quite a substantial proportion of people, are born with privileges, and I think this redistribution mechanism that occurs through the taxation system, through welfare payments, it's about assisting people that are less fortunate, I think. So anyway, it's the biggest item. So now, in addition to taxation revenue, funding essential services, infrastructure, and performing this redistribution function, which I've also listed here, and this point is covered in your book, the government to some extent uses the taxation system to engage in a form of social engineering, promoting behaviours that are considered socially desirable. So you can read about that in your book. A couple of examples. You can get tax deductions for donations to charities who are deductible gift recipients under the tax law. Okay, so they have to be, registered in the tax law as having that status. Right? Now, that is definitely about promoting philanthropy, a desirable form of behaviour. We do want, the government wants, and I think it's a good idea too, we want to create incentives for people to invest in and support worthwhile causes, right? Now, why we say that is about philanthropy, and it's a form of social engineering, is because the ability to get a deduction there cannot be understood pursuant to the general rule as to deductibility in the tax law. The general rule is that in order for an expense or outgoing to be deductible, it has to be connected with your generation of assessable income. It's got to be related to your business, if you have a business, or it's got to be related to your work, right? And the charity example has got nothing to do with that, right? So I'm not going to go through the whole list. Another example, on particular products, for example, the most extreme example would be cigarettes, tobacco, there's very high taxes. And part of the rationale would be, this is a very unhealthy product. So we want to create disincentives for people to buy this. Okay. Now, taxes are imposed by Parliament, right? Another word for Parliament is the legislature, right? But as I said, speaking informally, and even your textbook does it, we often say, it's the government introduced this tax, and that's okay. Look, in reality, they are in charge of the legislative agenda. Now, we do have taxes at the Commonwealth, state, territory, and local government level. In this course, we are only looking at Commonwealth or federal taxes. and we will focus on income tax. And the basis of income tax is Commonwealth or federal legislation. Now, a while back ago, and it's probably the same, either, if it's not the same figure, it's approximately the same figure still, right? Some years ago I read that there are actually 125 different types of taxes in Australia. That's a lot. But, you know, a lot of them wouldn't be that important, right? In that list of 125, by far the most important would be income tax. Now, I think I've got this somewhere later in the slide, but the most important state taxes are stamp duty, payroll tax, land tax. Yeah. So in this course, most of the course we'll look at income tax. We will also look at the GST, okay, the goods and services tax. Now, in terms of local government tax, that's rates, right, which landowners pay. And that funds services provided by local government, right, such as garbage collection and other things. Now, if we look at the Commonwealth, Federal Parliament, right, just going through the legislative framework. In Australia, sort of the most important law is the Constitution, and all other laws have to be consistent with the Constitution to be valid. So, and with the Commonwealth Parliament's power to tax, right, and with all of the laws that it makes, it has to be valid under the Constitution, and in fact, it must be the case that you have to find the authorization to make laws about that subject in the Constitution. In the case of tax, it's easy. There is a specific power to tax in Section 51, paragraph 2. That's the main source of the Commonwealth's taxing power. There are some other provisions in the Constitution which deal with taxation. Now, Section 90, that has actually been very important to the Commonwealth. When I say the Commonwealth, I mean the federal Parliament, or federal government actually, it's often used to refer to, right? And this Section 90, it's specifically about the power, and it gives the Commonwealth the exclusive power to impose customs and excise duties. I note that one, I think your book does too, in the history of Commonwealth-state relations, that has been very important. It's an important source of revenue for the Commonwealth. Only the Commonwealth can charge customs and excise duties. Excise duties, that means an ad valorem tax on goods, a tax on goods that increases according to value. It's often levied on luxury goods. It's an important tax, and why I say it's been important in the history of Commonwealth-state relations is that there have been lots of High Court cases, lots of legal battles where the Commonwealth is arguing a particular state, could be New South Wales, could be Victoria, is trying to levy excise duties, and that they can't do that. That's exclusively the power of the Commonwealth. Section 55 explains something for us, right? In this course, you will see, okay, even if we don't deal with them all, you will see references to lots of pieces of legislation, okay, statutes. Legislation and statutes mean the same thing, about tax, you know. With income, there's income tax legislation, there's GST legislation. You'll see reference to the FBT legislation, even though we won't cover it, and more, right? Why? Well, actually, I do think it's good in ultimately, because it creates more transparency in terms of the legislature, what it's doing in terms of charging tax. But why does it have to do that? Because it does have to do that. It's in the Constitution. Section 55 says that laws imposing taxation shall deal with only the imposition of taxation, one kind of taxation. It can't have, constitutionally, you can't have income tax and GST in the one piece of legislation. Okay. Section 114. Look, and this is just a for your information point, right? I'm not going to examine you on this or really anything to do with this constitutional framework. The Commonwealth and the states, they can't impose tax on each other, on each other's property, right? What's that to do with? It's to do with a foundational concept in terms of the Constitution. And the Commonwealth and the states are supposed to be, to some extent, or independent and autonomous of each other, right? And in fact, you know, the states, former British colonies, existed before the Commonwealth of Australia. And in agreeing to form the Commonwealth, part of the agreement was that they would have some autonomy and independence. Actually, it's a reciprocal concept. They are supposed to have a degree of independence and autonomy and to respect each other. Right. Now, so in terms of state taxing power, which, and again, this is a for your information point. When I say for your information, for your own knowledge, that means this is for your interest and education. I'm not going to examine you on it. States, their constitutions are different to the Commonwealth. They do have constitutions, but they have a really wide law-making power. Under their constitutions, they can make laws for the peace, welfare and good government of the state. It's not like the Commonwealth Parliament where it has to find a head of power, make sure that, you know, this is a subject on which it can make laws about. So the states they do have the power to make laws with respect to taxation, and in fact, before 1942, there was state income tax, and before 1915, it was only the states that charged income tax. So they have the power, but look, for a long time, it's been only the Commonwealth that has charged that very important big tax, income tax. As I said earlier, the main state taxes are stamp duty, payroll tax, land tax. Now, look, again, another for your information point. Really, there would not be much point in the states creating an income tax statute, right? Under the Commonwealth Constitution, if there's any inconsistency between Commonwealth and state laws, Commonwealth law prevails, federal law. And that test has been interpreted really broadly, and with the High Court adopting the same kind of test used by the US Supreme Court, right? It's not just referring to direct inconsistency. If the federal parliament has shown an intention to comprehensively regulate a field, such as income tax, then the High Court takes the view there's no room for the states to make laws about the same subject, right? So there's no point. Yeah, look, so territories, there's taxes at the territory level as well, but just for your information point, territories are very different to states constitutionally, like the ACT, Northern Territory. Territories are creatures of the Commonwealth Parliament. They really belong to the federal parliament, and whilst they are given a certain degree of autonomy, they can be destroyed by the Commonwealth Parliament, whereas the Commonwealth Parliament cannot destroy the states. It can't create a statute saying this, you know, the states are hereby abolished, That would be unconstitutional. It does not have the power to do that. Okay. Now, let's go on now to this jurisdiction to tax. Now, this is really getting to something quite central, right, to taxation law. Very critical. But we're going to do it in detail next week. Okay. As with all laws, in order for the taxation law to apply, there's got to be a connection with Australia, right? So what is the connection or nexus, right? Means the same thing here. That's required. Well, it's in the tax law, in the Income Tax Assessment Act, right? Okay, I'm going to talk about income tax law because that's mainly what we're looking at in this course. Oh, you will see there are nexus requirements with GST law as well, which we will get to eventually. Now, the connection that's required in the income tax law is this, that if you're an Australian resident for tax purposes, okay, so for tax purposes, we will see what that means next week, you are subject to tax on your worldwide income, right? If you are a non-resident, right, so you're not an Australian resident for tax purposes, that's what we mean, right? Then you are only taxed on your Australian-sourced income. So the nexus rules, the connection to Australia that we need is either residence, Australian residence, according to tax concepts, or Australian source, right? So it means if you are a non-resident, there's no way that Australian law can apply with respect to your foreign-sourced income, right? Your non-Australian sourced income. There's no connection with Australia. Even if the Commonwealth Parliament purported to, that is, tried to tax non-residents on foreign-sourced income, I think a court would hold it invalid because all law has to be valid in terms of, you know, what it can apply to. Right. But, you know, we'll talk about that next week. And actually, I've been thinking about it more deeply recently, about jurisdiction to tax. And whilst we have these general rules in the Tax Act, actually, they are subject to some substantial exceptions. And I am thinking, in terms of a critical evaluation of these rules, I don't know really how useful they are anymore. So yes, we will present the rules, we will look at what the Tax Act says, but you have to keep in mind there are substantial exceptions, and we will talk about that. Okay, so I think some of these points now I would have already covered, but anyway. So yes, income tax, that's the main Commonwealth tax. GST, that's second most important. We'll talk about both in this course. Customs and excise duty, we mentioned that earlier. It comes in as the third most important in terms of its revenue importance. We're not going to cover it in this course. We just mentioned that it exists and it's somewhat important. Now, and yes, the focus is income tax, right. Now, yes, every year for these last several years, many years that I have taught this course, I go to the budget papers to get the most recent data on this. And you know, for all these years, it's varied only by 2 percentage points, right? 93 to 95%, right? That is the dependence of the Commonwealth Government on taxation revenue as a source of revenue. So if we look at the most recent budget papers that were released on budget night, which was actually the budget was in April this year, we see that total Commonwealth revenue is 447 billion, right? How much is tax revenue of that? 418 billion, 94%, right? See, before I started looking at this statistic, right, and your book has it too, you know, in terms of any preconception, I would not have imagined that it's that high. I think I was thinking, well, surely the government has some other sources of revenue. Investments? Well, very little, in fact. So it's absolutely important in terms of the functioning of government. Okay, and we've covered that point about the major state and territory taxes. Okay, now what this table shows is the breakdown, right? So this is looking at, you know, the $418 billion of taxation revenue, and then looking at, well, what are the most important taxes and what's not so important. Now, this is based on the budget papers released this year. So, and it's very similar to what your book has, but it is updated. So your book is on, you know, what was available last year, right? So we see that individual income tax contributes 50% to total taxation revenue. It's very high. Company income tax, 20%. Okay, if we look at the previous year, it was actually a bit less, under 20%, but it's 20% on the most recent data. So this is from the budget papers again. So the budget papers released in April. And so it's you see how important income tax is? If we add up individual income tax and company income tax, it's 70%. And then what's next most important is look at GST, 15%. So income tax and GST is 85% of Commonwealth taxation revenue. And that is what we will look at in this course. So mostly income tax and then a week on GST, right? Then if we look at, you can just peruse that table for yourself. See, FBT, it actually contributes, that's fringe benefits tax, which is something, if you work in Australia, even if it's not tax, you're going to hear this term, FBT. Maybe some of you have already heard of it. It is something of a nightmare in terms of compliance for employers. It's a tax imposed on employers with respect to certain benefits that they give their employees, that benefits other than salary or wages. So it's a compliance nightmare. It's extremely complex, but it does contribute very little in terms of taxation revenue. You see, customs and excise duties is really relatively big with that 9%. Sometimes in some years it's been a bit more than 10%, right? Okay, so let's have a look at the legislation. In this course, we are going to be dealing a lot with provisions from the income tax legislation, the Income Tax Assessment Act 1997, and the Income Tax Assessment Act 1936. You can always abbreviate that in your exam answers to ITAA 97 and ITAA 36. You don't have to write the full name. So now how this legislation works is that the income tax legislation, the assessment acts specify what taxpayers have to pay tax on, and then, but in terms of the whole mechanics of how it operates, there's further pieces of legislation. So then in particular the Income Tax Rates Act, that's what actually specifies what the rates are. But we won't really get into those other pieces of legislation. For your purposes, it's just the ITAA 97 and ITAA 36. So you'll see that the provisions in the 97 Act are far simpler, right? They're in the sense of they're far easier to understand. They're written in plain English, right, compared to the 36 Act. In the 90s, the government began this project of rewriting the tax law in plain English, and the idea was that all the provisions in the 36 Act would be, rewritten in plain English. I'll just stop for a moment. Excuse me, two ladies over there. So the one rule, I'll repeat it. We're really glad you're here, right? So please do come to the lecture. But the one rule, no private conversations, right? Thank you. Right. Because it's very distracting, for one thing. Yeah. It's distracting for me, and I think must be distracting for your classmates as well, right? So in the 90s, the government had this idea that the whole tax law, income tax law, should be rewritten in plain English, right? And it did rewrite a lot of the provisions, but then that project sort of came to they put the pause button on that project because there were, more urgent priorities to attend to, and it has never been completed, right? So it means we have both provisions from the 36 Act and the 97 Act. In terms of the core concepts we will deal with, it's actually mainly the 97 Act. And I think it's, compared to other legislation and compared to the 36 Act, it actually reads quite well. Right, the GST, so that's the GST legislation, and it's called a new tax system, Goods and Services Tax Act 1999. You can call that, in your exam answers, just the GST Act. It's perfectly fine. Now, an addition that I just put, in thinking about these slides just yesterday was another piece of legislation. I'm not going to examine you on it, right? Unless I think that it might be good for the take-home exam, but no. But the take-home exam should be, I think the idea is it's based on class material, so maybe not. But still I want you to know about it, the International Tax Agreements Act, because that is a very important piece of legislation. It is what gives effect to Australia's double tax treaties. We will say a few words about double tax treaties in next week's lecture. Now, Australia has entered into many double tax treaties, right? At least 40 with other countries. It's really interesting issues that come up, can be complexities, but I think really interesting when you get to the interaction of tax systems and who it's relevant to. It's in particular, it's relevant, or can be relevant, it's relevant to individuals, but it's very relevant for multinational corporations operating across more than one country. And this, one thing the tax treaties seek to do is to avoid double taxation. And they also, to some extent, allocate taxing rights, giving sometimes one country exclusive taxing rights. It's very interesting. Now, a point that I do want you to know that you can remember, right, that if you work in Australia, even if it's not taxed, it'll be useful if you work and live in Australia, is that the double tax treaties that Australia has entered into take priority over domestic law, meaning take priority over the tax legislation, over the Income Tax Assessment Act, of anything that Australian law says, right? If there's any inconsistency between a double tax treaty and Australian law. Now, there's one exception to that rule. So in general takes primacy. The one exception is the anti-avoidance provision in Australian tax law, right? that is sort of like the number one thing that takes priority. Okay. Look, and there's a reference to FBT, right? That's covered in separate legislation. We're not going to cover it in this course. Okay, so now, these are really background points. So I'll be fairly quick in going through this because I do want to introduce you to the tax formula, right, which we will cover in a lot more detail in coming weeks. And I do want to get to that, simple tax calculation at the end as well. So in terms of tax administration, well, there is a separate piece of legislation about that called the Tax Administration Act that establishes a Commissioner of Taxation, right? And the Commissioner of Taxation is really the top government officer, right? In terms of the ATO, the Australian Taxation Office, which administers taxation in Australia. And we're not going to look at that act in any detail, but it really establishes the administration of tax in Australia, provides for tax rulings, provides for the system of objections, right? If you are not happy with your notice of assessment from the taxation office, you don't have to just accept it. You can object to the ATO, right? And then continuing down the slide, if you're not happy with the result that you get from the ATO, that is the Australian Taxation Office, you can actually appeal to independent bodies. You'd start with the Administrative Appeals Tribunal, which is not quite a court. It is similar to a court, but not as formal. It will apply the law, though. Then, if you're not happy with the result in the Administrative Appeals Tribunal, you do have a right to appeal to the Federal Court. You would begin with a single judge of the Federal Court. If you're not happy with that result, you can appeal more. You can appeal as of right to the full Federal Court, where 3 judges will hear your case. If you're not happy with that, well, there is one more option. It's not a right, but you can try. You can you can seek for special leave to appeal to the High Court of Australia, which is the highest court in the land. They may or may not hear your case. It depends on whether they think it's an important issue, an important issue of taxation raised. Now, I put that in terms of, well, you can do this, you can try appealing to the High Court. Actually, the person that likes to appeal to the High Court and is very successful in getting to the High Court, in having their matter heard, is the Commissioner of Taxation, right? The Commissioner of Taxation is very litigious. Often it's test cases that they take to the High Court, and in fact, the Commissioner of Taxation is so committed to getting authoritative pronouncements on matters of tax law that they will agree to pay the other side's costs, no matter what happens, right? Now, last point on this slide, an important tax resource are tax rulings. And in this course, I will post some tax rulings. There are some very useful tax rulings on residence and source that will be posted next week. And those are the most important rulings in terms of the material that we'll cover. In the deductions week, I will post another couple tax rulings. What are tax rulings in terms of their status, right? That they are not actually law, but in a sense, in one important sense, it's virtually like their law in this sense. They are binding against the Commissioner, right? The tax law says that. The tax rulings are published by the Commissioner of Taxation, right? If you don't like something stated in the ruling, It doesn't bind you because you can argue in court that the ruling is wrong. However, if you do like what's in the ruling, the Commissioner is bound. It's binding against the Commissioner. So it's a very important point in tax practice if you ever work as a tax accountant or a tax lawyer, because it's wonderful if you find something in a tax ruling that's favourable to your client. It means you're not going to have any trouble with the taxation office. Okay, so let's continue. Now we're getting to really practical aspects of this course, which of course we're going to do in a lot more detail in coming weeks, but it's good if you can pay attention and process this now, because the more you get, at this stage in terms of key concepts, the easier the rest of the material will be. So now we're looking at income tax, right? So this is an overview of income tax. So who pays income tax? Individuals, certainly. Now, because I think most of you have part-time jobs, right? Yeah. Do you all have part-time jobs? Or some may have full-time jobs, in fact, but do you all at least have part-time jobs? Don't worry if you don't, because I'll tell you something in a moment. Look, is there someone that doesn't have a part-time job? I was like you. At university a long time ago for me, I didn't have any part-time job because I wanted to spend all my time studying, and my parents thought that was fine. So, but it's so I think it's totally fine. It's a very individual thing, but I know most of you do have part-time jobs, which means, have you paid tax? Yes, yeah, good. So you will see this. Do you see tax on your payslip? It's withheld at source, right? Your employer withholds tax. Yeah. Now, we will cover this in the first tutorial. When when tax is withheld from your pay, right, and what happens is your employer sends that to the ATO, that is not a final tax liability, right? And I think maybe some of you have already experienced it, because most of you don't have full-time jobs, you have part-time jobs. So I'm expecting you're getting big tax refunds. Is that right? You're getting refunds, or certainly you should be lodging tax returns, because if you're a part-time, if it's part-time work you've got, I expect that you will be entitled to big refunds. So it's in your interest to lodge a tax return to get that refund. So who's lodged a tax return in Australia? Good. But more people than that had part-time jobs. Anyone else lodged a tax return? Good. Don't worry, I won't ask you the details of it, but just want to get a sense of who has experience with this. Right. So hopefully you've gotten, I'm thinking you've gotten refunds, right? Should have? Anyway, don't worry about that, but there's a good, nice practical question for you in next week's tutorial, where you have someone, and look, we'll cover that point in more detail, right? There's a pay-as-you-go tax collection system, but it's not a final determination of tax, right? And either you'll get a refund or sometimes you will owe tax, okay? I don't expect that is going to be many of you. Right. Now, so companies pay tax, trustees of superannuation funds pay tax. In terms of what is the tax here, in In the Tax Act, it's defined as from 1 July to 30th June, right? So it corresponds to what business regards usually as the financial year. However, companies can apply to the Commissioner for a different year, for a different tax year in their individual case. Now, in this course, in problems, the income year we will use is the 2018-2019 income year, right? So it will be the income year that started 1 July 2018 and ended 30 June 2019, right? And so if you're an individual, unless you've got a tax agent in which you can, and in that event you get longer, your tax return is due 31 October 2019 for the 2018-2019 income year. So I usually lodge mine for the last several years around 31 October. That is because I don't mind saying that I owe tax. That's the position that I tend to be in, and if you owe tax, you don't have any incentive to lodge early. Okay, and then for companies, it's actually, they also have a pay-as-you-go system, but in terms of the final determination of tax for them, it's based on the previous income year, right? They get more time to work out the final position. Right, so here's a diagram, right? I think I sourced this, now it's many years ago, from something the publisher provided, and I thought it was very good. So here's the income tax formula, right? This course is going to be both practical and theory-based as well, right? We want all the knowledge of tax law, right? We want explanations that are based in the law, and we want citation of law, but we want you to be able to calculate tax liabilities and give practical advice as well, right? So we see that income tax, how do we get to income tax, right? An income tax liability. Well, it's based on taxable income multiplied by tax rate or rates. With individuals, we're talking about rates. With companies, we talk about just one rate. Right? Now, you see with taxable income, well, what is taxable income? It's assessable income minus allowable deductions, right? And you can use these abbreviations. I think probably it's a good idea. Look, if it's to write it in full once, right? With you, just a general point with abbreviations. Abbreviations are okay, but write it in full once if we're talking about assessment. So, assessable income minus deductions. Assessable income, what's that? It comprises ordinary income. We're going to explain what that means in week 3 in some detail. And statutory income. Deductions, in turn, that's broken down into general deductions and specific deductions. You recall when I mentioned that example with charities, right, that you can get a tax deduction for a donation made to a charity who is a deductible gift recipient? Now, that would be a specific deduction under the tax law. It doesn't satisfy the general rule as to deductibility. So general deductions are expenses or outgoings that meet the general rule. Now, you see there's at the top line, very end, it says minus tax offsets, right? Tax offsets reduce tax liability dollar for dollar, right? You'll see that a deduction doesn't work like that. Deductions reduce taxable income, but the extent to which you benefit from a deduction depends on your tax rate. If you have a higher tax rate, you benefit more from a deduction. You will see that when we look at these concepts in more detail and we apply them to problems. Okay. Now, there's also additional charges. Well, Medicare levy, right? Look, sometimes we've had other charges and they've been temporary. Like, for instance, in the last 10 years, there was the flood levy, right? That was to assist in the repair after the Queensland floods, right? We don't have that anymore. But so Medicare levy has been around for a long time, since the early 80s. Right. Well, I mean, the Medicare system dates from the mid-70s, but it was funded from general revenue until the early 80s. Now, so Medicare levy is 2% of taxable income, provided you are above the Medicare levy threshold, right? The threshold amounts might actually be in this slide, but I'm going to post a cheat sheet to Wattle tomorrow, right? I have to write a note to myself to do it tomorrow, where you'll have in one sheet, you know, the rates, the tax rates that you need to know, you know, the Medicare levy, threshold amounts, and the ones applicable for the Medicare levy surcharge as well, and, you know, other things where really it's a nuisance to try and memorize it all. You want it in one sheet, and it's an open book, going to be an open book exam, so you can bring any printed material to the exam. Right. Medicare levy surcharge. This is an additional amount of Medicare levy that relatively high income earners, who the government thinks are high income earners, might have to pay. And it kicks in for individuals, potentially, you have to think about Medicare levy surcharge from $90,000, and it starts at 1%, and then if you're all the amounts will be in the cheat sheet, then there's a rate of 1.25% that could be applicable at from around 105,000, and then above 140,000, 1.5%, if you don't have appropriate private health insurance, right? So you can get out of you can escape the Medicare levy surcharge even as a high income earner if you have appropriate private health insurance. I say appropriate because it's not necessarily every private health insurance policy which will relieve the obligation to pay the Medicare levy surcharge. The health policy itself, your health provider will tell you. It will have a statement there as to whether it is good enough to avoid the Medicare levy surcharge. Basically, it has to be a reasonably good health cover policy, right? It doesn't have to be absolute top premium, but if it's a kind of healthcare cover that where it could be doesn't cover a lot of important things, it might not be good enough in terms of avoiding the surcharge. Now, help debts, okay, and it used to talk only of HECS, but help debts. This is about, just for your information point, this is relevant to domestic students, right? So Australian domestic students, in relation to their tertiary education, it's subsidised by the government. Australian domestic students, they don't have to pay anything up front. Okay, they can pay it up front and they get a discount, but don't have to. And but it does have to be repaid eventually, right? The Australian government, unlike some other governments in the world, does not give completely free education, right? With respect to tertiary education, it does, if a person, if a domestic student chooses to not pay up front, they will have to pay eventually through the taxation system, once they start earning money, and that amount that's applicable that they have to pay back increases according to their taxable income. And yes, so I had such a debt myself, and it took, how long did it take? About 8 years to repay. But, you know, you don't feel it so much because it's through the taxation system. But, yeah, so that's how it's recouped. Okay, so another slide on Medicare levy. We've said that it's 2% of taxable income. That's the basic levy. Look, some people are exempt. Non-residents. The Medicare levy is only, should have made that point, it's only payable by residents. So the thinking is, no, I mean, what is Medicare levy for? It's really an earmarking of taxation revenue to fund public health care. Because we do have a public health care system in Australia which is available to Australian permanent residents and Australian citizens. But built into this Medicare levy is the idea that, well, if you can't benefit from the Australian public healthcare system because you're not entitled to access it, you shouldn't have to pay it. So non-residents don't have to pay Medicare levy. So, you know, there are, say not a non-resident, say you might have to pay tax in Australia as a non-resident because you have rental income from Australia, right? Even though you're non-resident, say you live overseas even, but you don't have to pay Medicare, okay? Then who else? Then look, sometimes the rationale for, there's various different rationales for exemption from Medicare. So members of the Australian Defence Force are exempt. And then, you know, there are some people where the government thinks, that they're entitled to free medical treatment and they don't have to contribute to Medicare levy. Then, now this is relevant, I think, for many of you because many of you, I think, would not have permanent residency, right? You don't have PR in Australia. Now, note, if that's the case, if that applies to you, you don't have to pay Medicare levy. However, now, could we have everyone paying attention, right? So no private conversations. However, in order to get this exemption, you do have to do something. You actually have to apply to Medicare for an exemption certificate. Has anyone, because a couple of you at least, and probably more of you, are lodging tax returns, right? And the thing is, unless you get this exemption certificate, part of the tax that you've paid as you go would have included Medicare. But so you can get some of this back if you get the exemption certificate from Medicare. Has anyone got the certificate? Any of you? No. Well, you are entitled to do that. Okay. Give Medicare a call, or yeah, Department of Health. Yeah. Now, if we look at, you know, Medicare levy, it does not apply to the lowest income earners, right? So now these are updated for the latest figures, and so this is more up to date compared to your book. So below this amount, 22,398, then you do not have to pay any Medicare, okay? Then we have something called, okay, there's this sort of phase-in limit, right? Then we have this upper threshold, 27,997, right? Above 27,997, this is for individuals, you will pay the full Medicare levy, 2% of taxable income. Now, normally I just have this in the cheat sheet, but there are usually some questions about this, so this time it's in the slide, that in between these amounts, in between the threshold amount and the phase-in limit, what do you pay? You pay 10% of the excess above the threshold amount, which is 22,398. So an example, say we're talking about taxable income of 23,560, right? The Medicare levy you will pay is 10% of that excess above 22,398, right? And it ends up being $116.20 there, so $116. Now, that 10% of the excess is always better than 2% of the whole amount, right? So it is a benefit because it's only 10% of the excess above 23,560. No, sorry, 23,560 was the example amount. It's the excess above 22,398. Right. Now, I think some of these points we've touched on already, right? So you are required to lodge a tax return. Well, certainly if you've had tax withheld from your pay, you are required to lodge a tax return, right? So, and even if you earned below the tax-free threshold, and in fact, it's absolutely in your interest to do that, because say, if you noted what I said, right, it is entirely possible that you've earned below the tax-free threshold for the year, but you have paid tax under the pay-as-you-go system. What does that mean? You are entitled to a full refund, right? Okay, we'll go through in a bit more detail about exactly when you have to lodge a tax return, but most of the time you've got to lodge a tax return if you generate taxable income. Right, so, you know, and we've got this pay-as-you-go system. Tax is withheld at source, right? So in an employment situation, your employer will use the tables, will use withholding tables published by the Australian Taxation Office. They are publicly available on the internet. So your employer looks at, well, how often are you paid? Say it could be fortnightly, could be monthly, right? So if it's fortnightly, it'll go to the fortnightly tables, look at how much you're paid fortnightly, and these ATO tables will say how much tax is to be withheld, right? And then that is sent to the ATO. Now, how these withholding tables work is that it annualizes whatever you earn in, you know, the fortnight, the month, and then assumes that the basis is that's what you're going to earn the whole year, which might not be the case. So as you'll see in the question in the tutorial, where someone worked, they generated quite a lot of income over summer, but not really anything in the rest of the year, well, you'll see they're getting a big tax refund, right? Okay, so individuals, they lodge tax returns and get notices of assessment. Companies are full self-assessment entities, right? Companies and trustees of superannuation funds, they don't receive formal notices of assessment from the taxation offices. Their tax return is deemed to be their assessment as well. However, of course, they still have to comply with the tax law. You know, that they could be audited by the taxation office. Now, we'll talk about this more towards the end of the course, though. These days, in recent years, though, the taxation office really doesn't do much, I understand, in terms of audits. Audits have really declined in recent years. However, but the reason is that the technology, the ATO technology for detecting anomalies in your tax return has really improved. So there is a sort of a screening and detection that occurs, but it's through the technology, and they rely on audits less. Yeah. Right. So now let's look at this. This is I mean, this is really critical, but at this stage, it's just by way of overview, because these concepts, we're going to spend weeks on them, right? They're absolutely central. So we see, okay, we've said this before, but we've got it here. Now, taxable income is assessable income minus allowable deductions, right? So, you know, we're going to spend 2-3 weeks on income, deductions about 2 weeks at least, right? So assessable income, it comprises ordinary income and statutory income. We'll spend the most amount of time on ordinary income. Now, what is ordinary income? And if it's ordinary income, it means it's assessable income, which means it's going to be subject to tax, right? Because you see, with taxable income, it's assessable income minus allowable deductions. So ordinary income is a judge-made concept, right? It's judges that have developed that idea of what's ordinary income, right? And so there are certain preconditions for a receipt to be ordinary income, but that's not enough. Then there is sort of a key test that you have to satisfy. So in order for a receipt to be ordinary income, it's got to be cash or convertible to cash, and it has to be viewed by a reasonable person as a real gain, a real economic gain to the taxpayer. Those are preconditions. They're necessary but not sufficient. The further test that needs to be satisfied is, okay, now this is mainly it, but there is one qualification to this as well, right? That there must be a nexus or connection with an earning source, right? So now here I'll talk about a classic analogy that an American judge is credited for, because I think it's quite useful in understanding the nature of income, right? It's the fruit and the tree, right? So you can think of the tree, right, as the the asset, the capital, and the fruit. The fruit is the income, right? So now ordinary income, I think the nature of it is, look, it exists in relation to capital. That's where it gets its conceptual coherence, right? So it's like, so with the fruit and the tree, that tree is the asset which bears fruit, and we can take the fruit from the tree without destroying the tree, and the tree is available to generate more fruit, more income for us, right? So the tree you can think of as the earning source. So if we apply that concept to situations, right, real life situations where we know we've definitely got ordinary income, okay, you think about rent from property, right? So the property is the asset, the capital, it's the tree. The rent, that is a flow from that property. That's the fruit from the tree. And it comes from that earning source. And a really important feature of ordinary income is that we can take the income from the earning source or the asset or the capital without destroying that asset, right? If we're actually destroying that asset in taking that gain, it means we're not dealing with ordinary income anymore. We're dealing with a capital transaction, right? So other examples, salary and wages, it's definitely ordinary income. So that's something we're all familiar with, right? wages and salary is ordinary income. It's part of assessable income. It's taxed. And it's on that reasoning. There's a nexus with an earning source. What's the earning source? It's actually our earning capacity, right? We have skills. We have, you know, our abilities and skills. That's our earning source. Now, so interest. So interest from a loan, the interest is ordinary income. Any more examples that you can give me? Anything I haven't mentioned? I mean, there would be things I haven't mentioned, right? So, another one just here is for a business, the business profits, right? Anything else? Sorry? I can't quite hear it. Agriculture. Okay, sure. Okay, so agriculture, that's the setting. So what are you saying would be the income? Profits from that enterprise? Yep, sure, absolutely. Business profits, great. Then can you give me an example? Can you think of something in the company context with shares? What would be the income? Dividends, great. Intellectual property, can you think of what might be the income? Royalties, fantastic, that's great. Statutory income, the major example we have in the tax law are net capital gains, right? So capital gains are definitely not ordinary income, right? Because we get our whole concept of what is ordinary income from really making a distinction between income and capital. But the tax law, it's been around for a while, since 85. Capital gains are taxable, and it's a form of statutory income. So statutory income is where the tax law says a particular receipt is income. Deductions, really I've gone through that, so I might virtually keep going. But basically, there's general deductions and specific deductions. General deductions means it satisfies the rule in Division 8, where the expense or going is connected and occurs in the course of a person's generation of assessable income. Specific deduction, it's because a specific provision of the Tax Act says we can deduct it. Now, let me see. Sort of needed some idea of what the time is. Okay, so tax rates. So this is pretty important actually. It's not difficult, the tax rates, but it's important because we are actually, it's very important in life. It's important to people how much tax they pay, but you're going to do in this course calculations as well as knowing the theory, so it's very important to know. So for individuals, we have a set of rates that apply, not just one rate. You'll see that in the slide coming up. Now, in addition to these rates that we have for individuals, and there's different rates for residents and non-residents, there's also some special rates that apply to people on a working holiday maker visa, right? And this is relatively new in the law. That they pay, it's sort of in between. The end position is that it's in between resident and non-resident. So it's not as good as being a resident in terms of residents get a tax-free threshold, which the working holiday maker does not get. But they get taxed, this 15% rate applies up to $37,000, right? And that is actually, it's quite a bit better than non-residents. That's probably, yeah. No, I haven't made up my mind whether that's a purely for your information point. It may be, because I don't think I've examined on working holiday makers, but I think it's important for you to know anyway. Companies, they pay a flat rate of tax. Probably you're still learning in accounting that it's 30%. Okay, well, it's been changing in the last few years. And in terms of government policy, you know, the intention is that within the next 10 years, in less than 10 years, that all companies are to be taxed at 25%. That's where it's going. Now, and it's being implemented progressively and not all at once, but the current position is that companies called base rate entities, right? These are entities with a turnover, that is revenue, less than 50 million. So it's a lot of companies are going to be on this lower rate. They're only taxed at 27.5%. Now, there's a further rule that applies, which I will write it in full, state it in full in the company's lecture after the break, and that is that in addition to being below this turnover threshold, it must be the case that, you know, the company cannot be generating a large portion of passive income. We'll get to the precise figures then. But passive income is, you know, things like interest, rent, right? The idea is that you've really got to be carrying on an active business to get this 27.5% rate. Okay, for the very biggest companies in Australia, like the absolute, you know, highest market capitalisation companies, which also have the biggest revenue, that it's still the 30% rate that applies. Okay, in terms of other structures, such as trusts, it's either the trustee or the beneficiary that pays tax. In relation to undistributed trust income, the trustee will pay tax. It can be at a penalty rate, the highest marginal individual rate applied as a flat rate. We will look at that in the trust lecture. Complying superannuation funds at rate is 15%. That is, for your information point, we are not going to examine superannuation funds in this course. Okay, so those are the rates, right? There they are. And you will get a cheat sheet with the rates as well. There has been, you know, quite a bit of change just with this in the last few years, you know, just even last year, that middle bracket, that 37,000, the 32.5%, it went up to 87,000. And now it's 90 with the resident rates. So those are the sort of things where you've really got to make a note if you're managing with with an old version of the textbook, that it's up to date. Okay, and you see with non-residents, there's no tax-free threshold, right? So on every dollar of taxable income, right, tax is paid, and it starts at 32.5%, up to 90,000. From 90,000, it's the same as residents. Okay. Oh, I just realised I said May 29 budget. It was actually in April, the budget for 2019. It's usually in May, the budget. But anyway. Now, again, if we could have everyone listening, right? So this is about these next couple of slides, just letting you know that there's been quite a bit of change, right? In fact, so much change really in terms of what the government is calling the sort of the personal income tax plan, the tax rates and offsets that are applicable for individuals, that it's really hard to believe this actually, but that the government announced a series of changes last year, 2018, to apply for 2018-2019, for this income year we're looking at, right, including LMITO, the new low and middle income earner offset, right? But before that law could actually apply, right? So, and actually, look, it passed the law last year, but before it became relevant for the income year, it passed another law, which actually virtually, in terms of the low and middle income offset, for most people, doubled the benefit. So it's like before a change could be implemented in practice, a further change. That's sort of how fast things have been moving on that front. So if you're interested, you can, actually it's more than that actually, I would say. I would actually recommend that you look at those web links, right? Now, and actually in relation to these offsets, so these are benefits for taxpayers, right? There has been for a long time something called the low income tax offset, right? The amount is $445, and you get that full amount if you earn taxable income of no more than $37,000, and you get, you know, a partial low income tax offset if your taxable income is between $37,000 and around $67,000, right? It's a bit less than that, 667, right? Now, so the LMITO, right, that's the abbreviation used, the low and middle income earner offset, that was the government's initiative introduced last year, and last year it was supposed, for the major band that benefits people on incomes between $48,000 to $90,000, it was last year $530. In the April budget, it was doubled, a little bit more than doubled, to $1,080, right? So, and actually then the opposition, Labor, tried to match and tried to beat it. And so actually we wrote a piece, myself and Helen, who is a tutor for some of you, about these policies and sort of a critical evaluation of them, right? So ours is more critique, right? And looking at equity. So there's the link, right? It's on the, as part of the budget forum of OzTax Policy, which is the blog of the Tax and Transfer Policy Institute, which is run out of the Crawford School at ANU. And actually, we have one of your tutorial questions, the last question, is actually asks you to look at the article and sort of form your own view, right? What do you think? Do you think it's fair, unfair? You know, whatever is your view, we're interested in your view. Okay, so look, let's see how much time we've got, because I do want to get to that example. Okay, look, I think we're doing okay for time. Right, so now you can just work through this as well after the lecture and perhaps next week when you're going through the tutorial. But I did put a little example into the lecture because students often have questions about it, about, you know, working out a partial LITO. So LITO is the abbreviation for the low income tax offset. So so this person, Jenny, earns taxable income of $40,000, right? So they get a partial LITO. So what's the partial? It is that, well, it's $445, and for the excess above $37,000, it's reduced by 1.5%. So that's how the calculation works. And in her case, then it's going to be, well, it's only a little bit above $37,000, and she gets most of LITO, and it's $400. So LMITO, here are the details, right, of how, according to the current law, this was this legislation that gave effect to the government's policy announced in the 2019 budget, which is an improvement on 2018. This was passed this month, early July, right? The law was passed. So in our article, what we call the 2019 government proposal, because that article was written in April, that is now the law, the 2019 proposal of the government, right? And that is as per, these Lamito points. So below 37,000, you get Lamito of $255, then an increased amount between 37,000 to 48,000, and between 48 to 90K, you get the full amount of 1,080. And one point, and our article goes through this and looks at sort of the addition of LITO and Lamito and the interaction, right? Some taxpayers, right, if you're in, below, the relevant income bands, you can get both LITO and Lamito, right? So, now if we can, so this actually shows it. So with Jenny from above, so she gets a certain amount of LITO, she also gets some Lamito, right? She gets some of the low and middle income tax offset. And how it would work is, so she gets $255 plus 7.5% of the excess above 37,000. I mean, so have a look at the article. It's part of your tutorial. And we, I hope you find at least some part of it interesting, and the graphs. Yeah, Helen did the graphs. In fact, the thing was, she had done at least one of the graphs before the budget, and we were using it for teaching, and then we updated for after the budget, and then and then decided to write something, because we thought there was something to write about. But see what you think and whether you think it's fair, right? Okay, so this is really a snapshot of what's coming in terms of the future, right? Because in terms of the government's personal income tax plan, it's not just some kind of short-term plan. It is a vision for, if we get to, now looking at the last bullet point, if we get to looking beyond from the 2024-2025 income year, the government's vision is that there will be a flattening of the tax system. Look, if you believe in egalitarianism and a progressive tax system, right? But progressive means your average rate of tax should increase with your income. It's not really great, actually, from that perspective. Yes, it is the case that everyone is better off in the sense of everyone paying less tax. But now, and this is what our article looks at as well, but what about relative equities? And, well, we argue in the article that the Lamito of both parties undermines relative equity, right? That people with higher incomes actually benefiting a lot more. And this is an absolute flattening of the tax system in terms of the government's long-term vision, right? In the long term, the idea is, so there are some transitional measures. You can look at that for yourself, right, for 2 income years. But that, okay, the 37% rate is to be abolished. In fact, the 32.5% rate is to be abolished as well. So 2 rates to be abolished. There's going to be really three tax rates. Well, there's going to be the tax-free threshold still to 18,200, then a rate of 19% between 18,200 and 45,000, then then a rate of 30% between 45,000 and 200,000. So you can see that people on vastly different amounts of taxable income, this is a huge band, 45,000 to 200,000, paying 30% tax, right, the same rate. And then from 200,000, 45% tax. So this is a fundamental change in philosophy, right? In terms of, it's going to be far less progressive. But it is still quite a bit of time away, unless it's a case that, you know, we have a change in government and they decide to repeal all that. Okay, so, oh good, we've got to this point. So yes, we have time. So what this is just getting you to practice working with the tax formula, and really it's a practice of applying the rates, right? Because at this early stage, you don't have to really work out whether a receipt is income. You're just told, assume these receipts are income, assume these are deductions. So you work out then the taxable income, so it's just, you know, subtracting the deductions. Then applying the tax rates. So now it will be the resident rates that you apply, right? Because now assume this person is a resident, right? You're told she's 30, so she's, you know, she's not a minor. There are special issues that apply to minors. She has private health insurance, so assume that's appropriate private health insurance. Don't worry about the Medicare levy surcharge. And then the main thing is just to know how to apply those tax rates, right? So it's give her a tax-free threshold, right? She's a resident. Then, you know, between 18,200 and 37,000, apply that 19% rate, and then apply whatever rates are applicable. So can you take a couple of minutes to try and work through that? And then I'll display the solution, and that solution will be posted on Waddle as well.